All right, Michael, we are back for segment number 2, and we are with Mike Zuber from One Rental at a Time, and we are here to talk about syndications. Yes. True passive income in real estate.
Yep.
So, Michael, for those people out there, because both you and I are accredited investors, we can actually invest in most of these syndications. And by the way, so let's cover first what that accreditation is, number one. And number 2, then let's cover really what kind of a syndication is. So those people who don't know, that are hearing the word for the first time, we can actually get them up to speed quickly.
Yeah. So my understanding, I haven't looked at this in a while, but in order to be accredited investor, I think there's 2 criteria. You have to be one of the 2. I believe the first one still is you have to have $1 million net worth X your primary home. So primary home equity is not counted. Number 2 criteria is you have to make more than $200,000 a year in your W-2 and have reasonable expectation that you will do that again this year. Those are the 2 things. Again, I don't do syndications, but I am an accredited investor. I see this stuff coming, and I believe those are the qualifications, something like that.
Yes. If it's not that, it's very close to that.
Yeah.
So now let's talk about syndication. What is it? Teach me like I've never heard it before.
Yeah. So basically what a syndication is, again, assuming you can invest in one, is somebody goes out and finds a asset. It could be a small asset, but generally speaking, syndications are big, right? These are your big 30, 40, 50, $100 million apartments, right? And they're like, okay, let's just do $100 million apartment, for example. Generally speaking, you could go get a loan from the biggest, cheapest, Fannie, Freddie, right? They do big loans. They're going to come in for about 60, 65, maybe 70%, depending on the market. Let's say 65. Great. Very few people, very few families can stroke a check for $35 million. That's the down. So it's probably like $38 million with closing costs and all of that. So let's say you find a deal. It's a great deal. You don't have $38 million. Well, if you're an accredited investor, and again, I've never done one, but there's a process and a procedure and this filing and that filing. Basically speaking, you can go raise the money from other people. I'll get $1 million from Bob, $1 million from Mary, 100 grand here, 100 grand there. And basically what you're doing is that becomes the equity. That becomes the 35 million bucks. I would hope that the syndicator puts in their own money, but as we've seen the last couple of years, a lot of them aren't, which I think is terrible. A lot of syndicators are charging fees and management and that, the other thing, and that's how they're making money. And then what happens is you're promising or committing, or whatever the right term is, some kind of return, usually paid quarterly. Some people pay monthly, but that's not guaranteed. And they're selling visions of future IRRs and, we're going to burr the money in 3 years and we're going to get all the owner's equity back and we're going to own it. It's a great story. It is a great way to raise money. I about a year ago, maybe 18 months ago, I started warning LPs, right? Because you have a general partner, which is the raiser, and LPs, which is the equity, that a lot of you are going to get snookered because you're overpaying and you don't know it. You're getting killed in fees and don't know it. And once cap rates and these other things changes, you're going to get smoked in a refi and the equity's gone.
That's right.
So yes, it sounds great. It is truly passive, truly passive. Nothing is guaranteed. Lots of LPs were not seeing money February or March of 2020 because syndicators didn't want to pay because we didn't know who's going to pay rent, right? So it's no guarantee that money comes in. I think a lot of people got attracted to syndication because it was the next hot thing. The reason I went to meetups a lot, Matt, is because I want to see what the audience is doing.
Yes.
In 2006 and 7, everybody was flipping contracts. What that means is I would lock up a house and I would sell it's almost a form of wholesaling.
It is. Yeah.
Right. It's 15 years ago, wholesaling. And then it became actually flipping because HGTV made it easy. And then it was this, and then it was that. Syndication is that new thing. And anything gets hot like that, I run away.
Yeah.
It's too hot. Too many people are going to get hurt. You're not even going to know you get hurt. You're in bed with people you don't know, right? A syndication's got 10 people. You probably 9 of them you don't know, or 8 of them you don't know. And what happens if they got to sell and you don't? And it's just, people make them sound too easy.
Yes.
People are attracted by passive. People are investing in syndication because the content creator is a social media guru. That is the worst thing to do.
Yep. One of the things that I've seen on a lot of syndications is that I think we would agree that rates have never been as good as they are or have been, right?
Yeah.
Number one. Number two in line with what values are. It's been the lowest payment that probably will ever be paid for the property.
Yeah, probably.
Number two.
Mhm.
Number three is that debt is not 30-year fixed rate debt. It is,
Oh, dude, some of it's wicked short.
right. Some of it's 3 years. Some of
Dude,
it's
No, some of it's
year.
1 year.
Right.
1
right.
year.
Some
Bridge
of it-
debt, 1 year.
Right. So think about this. That is how Dave Ramsey got crushed. His was 90-day debt, but it was still very short-term debt.
That's a great point. Yeah.
Right. So this is one of the things. This is one thing that Michael and I can get with Dave Ramsey on when it comes to real estate investing, is that syndications, with that refi needing to occur, when that refi does need to occur, you have no idea what that rate's going to be.
Yeah.
And you very easily, they could have to raise cash, right? So they come back to you and say, okay, so before you were making 4% or 7% or 6% a month on your money. By the way, if you're anything above 6, that's pretty lucky, because the real returns on a lot of those deals are sub 6% on a lot of those syndications. Excuse me. That said, let's just say you're at 5 or 6%. They come back to you and say, hey, it's 3 years from now. Rates are no longer 3.5 or 3.25 that I got from Fannie Freddie. They're now 5.5. So I have to get two things from you. One, I need you to write me a check. And two, your dividend is going to go down. Your monthly payment that we're going to pay you.
Yeah. Yeah. There's actually, I think your Dave Ramsey example is great. So let me put a bow on that.
Please.
So if you don't know, Dave Ramsey was a house flipper before he was a multi-gazillionaire selling bad financial advice. So what did he do? He basically built a real estate portfolio that he admits was worth $4 million. He also shares that he had $3 million in debt on it. So Dave Ramsey was a millionaire before being a millionaire was cool. Because again, I think he did this in the 80s.
He did.
Like,
it was
when $1 million was like $1 million bucks. Right. So shout out Dave. But here's the problem. And this is why I think your Dave Ramsey example is exact. So in his scenario, it was lots of little houses that made up the 4 million and the 3 million of debt. But let's just pretend it's a syndication, right? Dave Ramsey went out, he raised, $1 million in equity from other people, $3 million in debt. Now the debt comes up to refi. For whatever reason, we're in a recession. We have an oil embargo, right? Some wacky nonsense happens and the lending market freezes up. The lenders go, yeah, I know the property's worth 4 million. And I know we gave you 3 million last time, but you have to refi.
That's right. Have to.
And we're only going to give you 2.5.
That's right.
So Dave Ramsey has a choice in a syndication. They can go to the limited partners and say, guys, sorry, banks only want to give us 2.5. We owe 3. Each of you owe a slice of that. And oh, by the way, all of you have to chip in. Or I'm going to sell the building at a fire sale price.
That's right.
And oh, by the way, all we can get is 2.5. And that's essentially what happened to Dave. He couldn't refi the debt, sell it at a fire sale. Just like all of these Chinese property developers are realizing net worth means nothing when you have to fire sale. And bingo, bango, he was bankrupt because he had bad debt. Dude, there is so much bad debt. There's bad debt. There's unrealistic rent increases. There is so much
Unrealistic
toxicity.
Vacancy rates. 99.8 I saw on one.
Oh,
99.8. What are you, nuts?
Yeah, you may have that today, but
Yeah.
is that normal?
No.
I mean, not normal.
No, never is. So one of the things that I thought was also really interesting about this, Michael, was there was an article specifically, this was an interview on Bigger Pockets. And this was something that was raised to our attention, and just, it was interesting. And we love it when people raise stuff like that, because we watch a ton of stuff.
Yeah, of course.
So the thing that bothered me most was that this was somebody that was in the game, made money in the real estate market, renting as a landlord, and then was just like, it's too difficult. We're going to move on and do other stuff. And then got into syndications. The thing that I don't like about it is that her and her husband got into 7 syndications. What is the likelihood that at least a third of those probably fail? Right? I mean,
yeah. So, I mean, if you got into 7 syndications in the last year or so,
yeah,
I would bet. Wow.
More than half of those have lost money, right? Already.
Because here's the problem, right? So here's every syndication I see today is promising an IRR of 15% or greater. My suspicion is 4 or 5 of those don't hit that at all.
Mhm.
And I suspect in a year or two, most of those will be cutting their dividends and asking for checks, because most of the syndications today are adjusting their reserves. Because again, this is all math, people.
Right. It is.
One of the ways they're raising capital and getting better IRRs is they're reducing their reserves. Why are reserves important? It's because roofs break. I have a 10-unit building that is actually 4 structures. I just had to put a $40,000 roof on it.
Yeah. Mm-hmm.
If you're not reserving for that and don't see it coming, what are you going to do? You're not going to fix the roof. You're going to patch it, let it destroy other units. You're going to go do a capital raise. I mean, yeah, again, and the other thing, dude, I just did a 10-year, I owned a 10-unit building for 10 years. Mm-hmm. And I bought it from somebody who overpaid last time. Mm-hmm. They bought it for $650 at the peak of the market. It was a C-class building. It's always been a C-class building. It deteriorated as C-class buildings do in a recession. And the person lost it 3 years later when they had to refi it, because it appraised at $650 and it appraised for less than $300 because they let it fall apart, and they just let it go. And I picked it up for $220.
Yeah. And imagine if you were if that guy were a syndicator.
Yeah, he walks, he loses some management fees, which, oh, by the way, he's been paid a gazillion on already.
Exactly.
Doesn't hurt him. Maybe he lost 1% because he threw in his first fee. He just included in the deal. Doesn't hurt him at all. It's just
it certainly isn't him bringing any money to the table. It's not wiping him out. It's not, it's him sending a letter to all of the,
sorry.
Yeah. With these challenging real estate times,
nobody saw him coming. So, nobody saw a 5% rent. Nobody saw rent staying stable, and nobody saw interest rates going up. Oh, wait, one rental at a time did.
Exactly. We talk about this weekly. So again, it's just one of those things where we've heard a lot of noise about syndication. Mm-hmm. Yes, it's a way to get access to the market. Absolutely is. It truly is passive income.
Yeah.
But the issue is, just like anything else, the devil's in the details. You must look and use logic to say these syndications that are acquiring at all-time low interest rates and that debt is not fixed, that is the wild card. That debt not being fixed is the wild card.
Yeah, what I would tell people today, and again, I talk down to syndications because, again, I see syndications almost daily. Mm-hmm. Most of them are bad. Some syndications, I don't want to make all syndicators.
True. Yeah, agreed.
It's not the case.
Agreed.
I actually have syndicators in my weekly expert series, but here's the deal. They haven't been doing a lot of deals. They are not making their money on fees. Right. So again, they couldn't get it there. So they're buying other stuff. They're buying for their personal portfolio. So again, I think syndications are great. I think syndications can be great, truly passive income. I just think the greatest percentage of them are horrible deals today. All-time high prices, all-time low interest rates, unrealistic rent, bad debt structures. It's just like on and on and on and on. And again, I've been doing this 20 years. There will be a time where syndications are great. You go get an adjustment in the apartment market. You got 5 years of flat rent. You got a cap rate up 2%, which hits values. I'll buy them again. It's just not today.
Yep, exactly. Not today.
And today.
If you're in 7 of them, you're not diversified. You're going to get crushed by a couple that will probably take out some of the others. Number one.
Yeah.
Number two, go ahead. Yep.
I would put $100 on it right now that 3 of those go poof.
I said exactly that. But here's the other thing. Here's the other thing that concerns me. They're getting $16,000 a month of income, but it's
today.
Yes, today.
Yeah.
Today. That's the issue, is that they are building based on that, and your rate of return is not going to increase. It's only going to likely decrease. And again, if you're in 7 of these, I would just caution anybody that thinks that this is the easy way to financial freedom. It just isn't. There's no easy way. There's no easy way to financial independence. You have to do the work. And at least what One Rental at a Time is sharing, and what I'm sharing with people, and what Dion Financial Talk shares regularly with people, is these are our journeys. And we have a level of control over that. And the only one that are collecting fees are us on our properties for us. So we can do the right thing for the property and keeping it up. And we can do the right thing by treating the tenants right. And it really becomes much less of a, you don't get rent strikes in duplexes.
Yeah.
You get rent strikes in 70 unit or 80 unit or 200 unit buildings. And that will cripple you.
Yeah. The last thing I'll say on this is please do not invest in any syndication where your main attraction is somebody being a social media star.
Agreed.
If you're doing it because somebody is a social media star, you're going to get hurt. Do the deal, do the due diligence, double check the numbers, run your own math. It takes work. Learn how to do it. Learn how to evaluate deals. And one more time, do not invest in anyone because they're a social media star. That is a bad idea.
Yep. And review the docs. Please just review the docs. Go through them. And if there's something there that you don't understand, ask an accountant. Please, it's worth it. It's a couple $100. Most CPAs are $200 to $300 an hour. Get the document in front of them. It'll take them an hour to review it. And that $250 could save you a long time of heartache. Mike, how can everybody find you, my friend?
One rental at a time. Website, YouTube, books, Instagram.
It's all there for you. So Thursday nights, 8 p.m., Mr. and Mrs. Lumberjack. We do a couple session live stream. Sunday mornings, 11:30 a.m. Eastern time. We spend 3 hours answering your questions. Please feel free to bring them. So subscribe, hit that like button, and stay tuned for the amazing segment number 3, where we get in depth with 2021 in review with Mike Zuber from One Rental at a Time. Easy for me to say. Thanks, Mike.